Chapter 4 of the economic survey of this year: Monetary Management and Financial Intermediation, a good year. Now, the year 2022 marked return of high inflation, especially in advanced economies. After nearly 4 decades, major central banks have implemented sharp increase in policy rates, with the Federal Reserve's rate hikes being steepest since 1970s. The RBI initiated its monetary tightening cycle in April 2022 and has since implemented a policy repo rate hike of 225 basis points. Consequently, domestic financial conditions began to tighten, which was reflected in the lower growth of monetary aggregates. Further, political and economic developments in 2022, the breakout of conflict in Europe, high inflation, and rising interest rates meant that capital markets around the world were characterized by increased volatility. However, domestic capital markets displayed some encouraging trends. The primary equity markets witnessed participation from all segments, especially with increased small and medium enterprise contributions, while primary private debt markets saw growth in placement and resource mobilization. Also, the increasing outreach of banking sector and financial capital market is reflected in the insurance and pension sector. Furthermore, net FPI inflows turned positive in the quarter ending December 2022. The indices have displayed a decreasing trend in volatility as measured by the India Volatility Index over this period. Now, regarding monetary developments, Monetary Policy Committee introduced the Standing Deposit Facility, that is SDF, which allowed for deposits of excess funds by bank with RBI without the necessity of collateral, thereby allowing effective liquidity management in a collateral-free manner. The SDF, introduced at a rate of 3.75%, replaced the reverse repo rate as new floor of the liquidity adjustment facility corridor. Now, liquidity conditions. RBI remained nimble and agile in liquidity management by conducting two-way operations. It injected liquidity to assuage transient liquidity tightness through two variable repo rates auctions. Further, gradual withdrawal of surplus liquidity pushed the weighted average call rates, the operating target of monetary policy, closer to the policy repo rate on an average basis. Moving on to monetary policy transmission, external benchmark based lending rate and 1 year median marginal cost of fund based lending rate MCLR increased by 225 basis points and 115 basis points respectively um, in this period. So, overall weighted average lending rates and weighted average domestic term deposit rates too rose. Developments in the GSEC market. The yield on 10-year government bond rose in 2022. The weighted average yield spike reflects the domestic bond market's volatility stemming from uncertainty in crude price, hawkish stance of major central banks, and a hardening global bond yield and pressure on rupee. Now, moving on to the banking sector, resilient and well capitalized banking system, the 4R approach of recognition, resolution, recapitalization, and reforms led to the enhancement of risk absorption capacity and a healthier banking system balance sheet, both in terms of asset quantity and quality. Credit growth aided by a sound banking system and deleveraged corporate sector. Now, retail credit driving the growth primarily owing to the rising demand for home loans. An increase in demand for housing induces greater investment, which in turn sets off a virtuous cycle of growth and investment. Implementation of emergency credit line guarantee scheme and the support provided by government's production link incentive schemes, PLI schemes. So, if we look at the broad based growth in sectoral non food bank credit, we see that agricultural and allied activities have seen, all the sectors actually have seen a varying trend. And we see that for agriculture, there was a dip in 2018. However, COVID did not much affect the agriculture credit takeoff. However, with industry, we see that there was a marked decrease during the COVID period. So was for services and in personal loan. So agriculture is an exception in the sense that COVID-19 did not affect the agricultural credit offtake. Industry was also affected, services was also affected, and personal loan was definitely affected. However, we see that after there is a marked increase during the COVID period for personal loans, which is obvious. Services, we see a marked decrease, and so for industry, we see a marked decrease. Moving on, NBFC continue to recover. Non-banking financial companies built up financial soundness during FY22, marked by balance sheet consolidation, improvement in asset quality, augmented capital buffers, and profitability. Now, NBFCs continue to deploy the largest quantum of credit from their balance sheets to industrial sector, followed by retail, services, and agriculture. Now, insolvency and bankruptcy code, some progress is made. Now, IBC facilitated the exit of distressed firms, thereby allocating scarce economic resources towards more productive use. Since December 2016, 5,893 corporate insolvency resolution processes has commenced by the end of September 2022, of which 67% have been closed. Now, 5,893 CRIPs commenced, 3,946 were closed, 1947 CRIPs are ongoing, and out of the closed, 846 by appeal or review are settled, and 740 have been withdrawn, 1800 has been gone for liquidation, and approximately 1800, and 553 through resolution plans. So we see that out of these, the closed plans, liquidation has taken a major chunk, approximately 50, not 50%, but approximately in that area. Moving on, behavioral changes, recoding business relationships, fear of losing control over CD upon initiation of CIRP has nudged thousands of debtors to settle their dues. Now, development in capital markets, primary market for FY22, number of small and medium enterprise coming with IPOs almost doubled. But the total fund raised by them were almost three times the funds raised by them in the same period last year. Now, underactivity in the public debt issuance was more than compensated by the private debt placement. The number of private debt placements increased by 11% in April-November 2022. Secondary market, heightened geopolitical uncertainty and supply chain disruptions post Russia-Ukraine crisis led to increased volatility in stock market. Now, capital market, number of DMATs accounts rose sharply, 39% higher by the end of November 22 on year-on-year basis. Still, incremental addition to DMAT accounts subdued due to increased volatility in secondary market and subdued primary market performance. Commodity derivative markets witnessed sharp corrections on account of monetary tightening by the Feds. Mutual fund industries assets under management increased by 8.1% by the end of November 2022 on year-on-year basis. Now, foreign portfolio investments, global economic factors such as inflationary pressure, monetary tightening by central banks, and recessionary fears in advanced economies exerted pressure on FPIs to sell in the Indian market. However, assets under custody, that is custodial holdings of FPIs reflecting the total market value of the holding, witnessed an increase despite the outflow driven by the global factors. Now, investments by domestic institutional investors acted as a countervailing force against FPI outflows. Now, for the crypto ecosystem, the recent collapse of the crypto exchange FTX and the ensuing sell-off of the crypto markets have placed a spotlight on the vulnerabilities in the crypto ecosystem. Now, crypto assets are self-referential instruments. They do not strictly pass the test of being a financial asset because it has no intrinsic cash flow attached to them. US regulators has disqualified Bitcoin, Ethers, and various other crypto assets as securities. Now, cross-country analysis, the crypto asset market has been very volatile, with its total valuation swinging from almost 3 trillion in November 2021 to less than 1 trillion in January 2023. Concerns regarding crypto are their fragile backing and governance problems, increasing complexity and non-transparency, concentration of crypto assets in the hands of few whales, monitoring and regulation, new centralized intermediaries such as crypto asset exchanges, wallet providers, and crypto conglomerates need to be regulated as systemic financial market infrastructures. Steps taken by countries or groupings. Now, European Union's digital finance strategy comprises regulating markets and crypto assets, that is MiCA. Japan Financial Service Agency mandating clients' assets segregation, operational risk, cyber security management, KYC, internal audits, minimum capital requirements. This was implemented by amending the Payment Service Act in Japan. Now, Swiss Financial Market Supervisory Authority issued three categories of token were introduced: payment tokens, utility tokens, and asset tokens. In United Kingdom's Financial Conduct Authority's final guidance on crypto assets focuses on stable coins and a proposal for a sandbox regime for blockchain-based FMIs. Moving on to the IFSC Gift City. Now, IFSC is a jurisdiction with a high concentration of financial institutions, very much needed in case of capital account convertibility. Now, IFSCA assumed the power of four domestic regulators, namely RBI, SEBI, IRDAI, and PFRDA, insofar as IFSC are concerned. Now, Global Financial Center Index, London report put IFSC in Gift City at the top among the 15 centers globally. Union Cabinet has approved the signing of two multilateral MOUs and seven bilateral MOUs by IFSCA to deepen cooperations with foreign regulators. Others, FinTech Bridge with Monetary Authority of Singapore, NSE IFSC SGX Connect, visibility and mindshare among FinTech globally, cooperation agreement between India INX and Luxembourg Stock Exchange, IFSC vision for FY24 and beyond, elevating GIFT IFSC to a virtuous self-sustaining trajectory towards becoming the nerve center of new age global financial services and activities. Sophisticated financial products such as bullion depository receipts, unsponsored depository receipts, and financial and operational leases have been introduced, creating a thriving knowledge economy by allowing foreign universities to set up operation in IFSC free of domestic regulations. Now, development in the insurance market. In 2021, total global insurance premium grew by 3.4% in real terms, with non-life insurance sector registering 2.6% growth. Insurance penetration in India increased steadily from 2.7% around the turn of the millennium to 4.2% in 2021. Life insurance penetration in India was 3.2% in 2021, but most of the life insurance products sold in India are savings linked, with just a small protection component. Now, insurance penetration refers to the ratio of total insurance premiums to GDP in a year. Insurance density refers to the ratio of insurance premium to population, that is, insurance premium per capita is measured in US dollars. Now, recent trends, the insurance sector is highly competitive and is already witnessing mergers and acquisitions activity. Additional FDI flows, IPOs, simplified rules and regulations, and improved corporate valuations will likely further accelerate. Accordingly, the General Insurance Business Nationalization Amendment Act of 2021 allows central government to pare its stake to less than 51% of equity capital in a specified insurer. Now we see that there is a steady increase in the insurance penetrations with a bit of ups and downs. Life insurance is up and down. We don't see a steady increase. Significant rise in insurance density. For that, we can say that yes, there has been a steady increase. However, in case of, except for barring like the COVID situation, we see that there has been a steady increase in non-life insurance. Moving on, government schemes and financial inclusion initiatives have driven insurance adoption and penetration across all segments. Pradhan Mantri Fasal Bima Yojana, Ayushman Bharat, Pradhan Mantri Jan Arogya Yojana, Pradhan Mantri Jeevan Jyoti Bima Yojana, Pradhan Mantri Suraksha Bima Yojana, Pradhan Mantri Vyay Vandana Yojana. Saving premiums are expected to decline due to volatility in financial markets and as disposable income falls. Heightened risk awareness due to COVID-19 may continue to support demand for life protection and health insurance products. Now, regarding pension sectors, benefit of employee state insurance corporations pension scheme was extended to even those who have lost earning members due to COVID-19. The insurance benefits was also enhanced and liberalized under the employee deposit linked insurance scheme. To enhance the ease of living of central government civil pensioners, an electronic pension payment order EPPO was integrated with DigiLocker, creating a permanent PPO record in the DigiLocker. Now, various pension schemes are being implemented. Indira Gandhi National Old Age Pension Scheme, Indira Gandhi National Widow Pension Scheme, Indira Gandhi National Disability Pension Scheme under the National Social Assistance Program. Now, National Pension System 2004, primary pension system for government employees with a pay as you go defined benefit plan. NPS was extended to all citizens of the country in the age group of 18 to 70 years, including the unorganized sector workers, on a voluntary basis in 2009. NPS corporate sector model in 2011 to provide NPS to the employees of corporate entities, including PSUs. 5 year 5 year period of FY17 to FY21 showed that 24% were female subscribers, with the balance 76% being male subscribers. Atal Pension Yojana. The scheme applies to all individuals aged 18 to 40 years with an emphasis on underprivileged, unorganized, and low income individuals. PFRDA steps for ease the accessibility of NPS and APY, reducing timelines for processing settlements to T plus 2 days. Central record keeping agencies have integrated their systems with DigiLocker. That'll be it for chapter 4.